The S&P 500 is often seen as the ultimate benchmark of the American stock market, a symbol of diversification, tracking 500 of the largest companies in the United States. But here's the truth. It is no longer a reality. The top 5 stocks, Apple, Microsoft, Alphabet, Amazon, and Nvidia, now account for over 25% of the index total value. That's right, just 5 stocks represent a quarter of the entire S&P 500. Apple alone accounts for nearly 7%, more than the combined weight of the bottom 200 companies. This concentration distorts the index's purpose to reflect the broader market. While the S&P 500 rose by over 16% in the first half of 2023, nearly all those gains were driven by just 7 mega-cap stocks. The other 493 companies? Many saw flat or negative performance. In other words, the S&P 500's success isn't about the market. It's about a handful of giants. So why is the index so top-heavy? Much of this goes from the explosive growth of the tech sector. Over the last decade, companies like Apple, Microsoft, and Nvidia have delivered outsized returns, driven by trends like artificial intelligence, cloud computing, and consumer reliance on technology. Since 2010, the tech sector has outperformed the broader market by over 300%, leading to its dominance in the index. But as tech giants continue to grow, they cast a long shadow over the rest of the market. This means that the S&P 500 increasingly reflects the performance of a few key players, rather than the diverse economy it was designed to track. For investors, this concentration creates hidden risks. Many believe they're diversifying by holding an S&P 500 index fund, but the reality is far different. If 25% of your portfolio depends on just 5 companies, you're far more exposed to their success or failure than you might think. This over-reliance on mega-cap stocks means that even a single earnings miss or regulatory challenge could ripple across the entire index.
The technology
In 2022, for instance, when tech stocks experienced a large drawback, the S&P 500 fell by nearly 20%, revealing just how vulnerable the index is to the performance of its largest components. So, what can investors do? Diversification is key. The S&P 500 no longer provides the broad exposure many expect. To truly spread risk, investors should consider adding small-cap and mid-cap stocks, which are less reliant on mega-cap performance. Over the past decade, small-cap stocks have outperformed large caps in periods of recovery, providing a potential hedge against concentrated risk. Investors can also explore international markets or sector-specific funds to reduce overexposure to U.S. tech giants. By broadening their approach, they can build a portfolio that's better aligned with the true diversity of the global economy. The S&P 500 is no longer the broad benchmark it once was. Its heavy reliance on a handful of companies means it reflects the performance of giants, not the true breadth of the market. For investors, understanding this imbalance is crucial. Diversification beyond the index is no longer optional. It's essential. Because when a few stocks drive the market, the stakes are higher. And in this environment, those who look beyond the surface will be better prepared for what's ahead.